The core business of a bank is to capitalize on the interest spread, which is the difference between the interest rates at which it lends and borrows funds. The aftermath of several bank failures in Europe served as a catalyst in realizing the need to protect depositors as well as shield the international financial system from disastrous developments. The Bank for International Settlement (BIS), based at Basel, along with key central banks throughout the world, initialized the process for putting adequate safeguards in place against bank failures. In this unit, you will learn about shortcomings of Basel I, need for Basel II, approach to Basel II, the three pillars of Basel II, calculating capital to risk-weighted assets ratio, CRAR, introduction to Basel III.
The safeguard initiatives from BIS came in the form of various Basel Accords. Basel I focused on the key issue of maintaining adequate capital based on weighted risks. Further accords, namely Basel II and Basel III, had a more comprehensive and holistic approach to managing risks for the banking sector. The key framework encompassed all the entities in the banking group and made an attempt to capture the extent of risk on a consolidated basis. It tried to ensure that the capital recognized in the capital adequacy measures provided sufficient protection to the depositors in terms of market, credit, or operational risk in the event of a crisis. The interest income or the net interest income (NII) generated by banks should take care of the bank's long-term sustainability after providing for default in repayments by borrowers and operational expenses. The concept of capital to risk-weighted assets ratio (CRAR) was established in order to determine the bank's capital adequacy, taking into account all the possibilities of the risk of default. When the earnings of a bank are not adequate to meet its obligations and expenses, there is a necessity to maintain a cushion, generally in the form of statutory capital, to absorb the losses so that the deposit holders are not affected. The formation and adequacy of this capital cushion was the primary concern that the BIS took up. Click the button. The main shortcoming of Basel I was that it focused primarily on the credit risk. It was later realized that the sole focus given to credit risk was inadequate, as banks were also exposed to market and operational risks in the long run. This necessitated the formation of the Basel II Accord, which focused on all three risks rather than only on credit risk exposure. Click each button to learn more. The key to Basel II objectives is the implementation of modern risk management techniques. Maintaining the risk management capabilities in the line with the risks of their business is also a key norm of the Basel II objectives. Basel I is focused on credit risks alone. Basel II induced a more sophisticated approach to credit risk in addition to operational and market risks. The approach necessitated banks to make use of the internal ratings-based or IRB-based approach to calculate their capital requirement for credit risk. These calculations are based on the ratings internally generated by banks to assess their assets. It should be noted that unsystematic risks are cushioned by earnings and provisions, while systematic risks need to be mitigated by capital. Click each button to learn more. Apart from the credit, market and operational risks, there are other risks like regulatory risk and reputational risk that also require capital cushioning. The most important function of today's banking scenario is to identify, monitor, quantify, manage, and control or transfer these risks. The enhanced risk management approach promoted by Basel II serves as a crucial tool for a bank's success. For the sake of uniformity, the policy approach towards Basel II in India is to conform to the best international standards laid by the Accord. Commercial banks in India have started implementing Basel II with effect from March 31, 2007. Basel II is a revision of the Basel I framework with three pillars, or aspects that mutually reinforce each other. The three pillars essentially provide for and govern the prescribing norms of minimum capital requirement, supervisory review of capital adequacy, and market discipline. This helps banks reduce systemic risks arising from credit, market, and operational risks. Click each circle in the image to learn more. Credit risk can be calculated in 3 different ways. Click each button to learn more. The CRAR is the fundamental step in analyzing risk exposure and making provisions for it. There are 5 stages in determining credit risk. They are listed below. Stage 1. Determining the category of the exposure out of the 5 given categories suggested by the RBI. The risk weight of the exposure depends on the category. The adjusted exposure to a borrower for his fund-based and non-fund-based facilities is calculated once the category is fixed. Stage 2. Determining the allowable reduction for approved financial collaterals or backing of deposits under lien. Stage 3. Refining the applicable risk weights. Basel II has further refined risk weights of standard assets for exposures on some entities such as sovereign and interbank and corporate exposures based on external credit assessments. In the supervisory category of non-performing assets, there is refinement of applicable risk weights based on the type of security and/or provision. Stage 4. The risk-weighted asset or RWA of the exposure is equal to adjusted exposures of the party net of allocable reductions multiplied by risk weight. Stage 5. The consolidated total RWA is the total of RWAs of all exposures. The total exposure of a bank for a borrower is the sum total of 3 kinds of exposure. Outstanding balances in fund-based facilities. Sanctioned but unavailed limits in fund-based facilities. Exposure arising out of non-fund-based facilities. The calculation of credit exposure allows for deductions for deposits under lien, keeping approved collateral. Click each button to learn more. There are three different approaches to calculate operational risk. Click each button to learn more. The lack of inclusion of market risk when calculating risk-based capital was one of the deficiencies of the Basel I Accord. Basel II attempted to rectify this by coming up with capital requirement for market risks. With respect to market risk, the preferred approach for calculating the capital requirement against risks is the value at risk or the VAR approach. RBI recommends the following approaches for calculating general market risk arising out of interest rate risk. Duration-based approach is the widely followed one. Click each button to learn more. The Basel II Accord of the Basel Committee has laid down the following 4 key principles with regards to the supervisory review process (SRP) envisaged under Pillar 2. Click each button to learn more. The Pillar 2 supervisory review process or SRP requires banks to implement an internal process called the Internal Capital Adequacy Assessment Process (ICAAP) for assessing their risk-related capital adequacy. It also necessitates that supervisory authorities to subject all banks to an evaluation process called the Supervisory Review and Evaluation Process (SREP). The responsibilities of the banks and supervisors are as follows. Click each The ICAAP and SREP are the two important components of Pillar 2 and are described as follows. Click each button to learn more. The broad parameters that banks are required to comply with when designing and implementing their ICAAP are as follows. Click each button to learn more. Other parameters of the ICAAP are as follows. Click each button to learn more. Pillar 3 provides disclosure requirements for banks using the Basel II framework. The areas of disclosure required are the scope of application including qualitative disclosures, the capital structure, credit risk involving general disclosures for all banks, credit risk for selective portfolios, credit risk mitigation involving standard disclosures for IRB, credit risk using IRB approaches, market risk, operational risk and interest rate risk, banking book, capital adequacy, asset securitization requirements, calculation of the ECAI recognition requirements using the standardized approach, supervisory transparency with strong remedial recommendations.
The latest in the series of Basel regulations, Basel III, is mainly focused on structurally improving the balance sheets of financial institutions as well as the financial system overall. The Basel III proposals cover 4 areas of concern emerging from the financial crisis, namely those dealing with capital, quality and composition, liquidity crunch, borrowing short and lending long, balance sheet leveraging and inconsistencies in accounting and valuation practices. The objectives of Basel III are strengthening of resilience of the banking sector against future shocks, supplementing the current recovery process, reducing the risk spillover effect of a financial crisis to the real economy. The Tier 1 capital ratio would require banks to hold 7% common equity, including 2.5% of capital conservation buffer. Under Basel III norms, banks have to maintain Tier 1 and Tier 2 capital as a specific minimum percentage of RWA. Tier 1 capital, in the nature of going concern capital, that is, capital which can absorb losses without triggering bankruptcy of the bank. Tier 1 capital also includes a minimum percentage of common equity Tier 1 capital. Tier 2 capital, in the nature of gone concern capital, that is, capital which would absorb losses only in a situation of liquidation of the bank. In order to strengthen financial stability of banks, Basel III has introduced a number of important concepts: Capital Conservation Buffer (CCB), Counter-Cyclical Buffer, Leverage Ratio, Liquidity Coverage Ratio and Net Stable Funding Ratio (NSFR). Click each button to learn more. RBI has given the full picture of the Basel III in a tabulated form as given below, once the full implementation of Basel III takes place.
As you study the subject, it will help to pause and check your understanding. Here is an exercise that will help you to do that. Read the instructions on the screen to complete the exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise.
In this unit, you have learnt the following. The revised framework of Basel II consists of 3 pillars which mutually reinforce each other. Pillar 1 stipulates the minimum capital requirement for credit market and operational risks, as well as promotes the requirement of a standard international rating-based approach. Pillar 2 promotes a supervisory review process that requires banks to implement an internal process called the ICAP. This process helps banks assess their capital adequacy in relation to their risk profiles, as well as helps them create a strategy for maintaining their capital levels. The fact that distinguishes Basel III from the previous attempts to improve the financial system is that it focuses on structurally improving the balance sheets of financial institutions. Basel III stipulated higher capital adequacy norms for Tier 1 and Tier 2 capital, while removing Tier 3 capital altogether. It also introduces new terms like Capital Conservation Buffer (CCB), Counter-Cyclical Buffer, Leverage Ratio, Liquidity Coverage Ratio, and Net Stable Funding Ratio (NSFR).
You have now come to the end of this unit. Answer these questions to see how much you know about the concepts you have covered in this unit. Go through the unit again in case